Okay, welcome back, everybody. It's Monday. Today we're going to be wrapping up Chapter 4, still dealing with the general and special revenue funds. Today we're going to be finishing up some transactions that are normally accounted for within the general fund, and we'll get into just some examples of some transactions we'll expect to see within some special revenue funds. And then we'll kind of look at just take a glance for a moment at what those statements, the balance sheet and statement of revenues, expenditures, and changes of fund balance is going to look like for each one of these funds. As we go through these examples again, unless you've actually read the chapter, the numbers can kind of get tricky where they're getting the numbers from. So just pay attention to like the examples and the actual structure of the journal entries as we go through it. Don't try to really follow the numbers too much. Some of them might make sense to you, but some might not. But if they're not, then just read the chapter. But for the most part, we should be able to accomplish what we want to accomplish today. On Friday, we left off we were talking about amending the budget. If you recall, it's this slide we left off on. Here we know that actually budgetary fund balance was down by 50,000 because estimated revenues were actually 50,000 higher than we thought they were going to be, and the appropriations control was $100,000 more. So obviously the difference between 50 and 100 is the plug of 50 for budgetary fund balance. So we know that. So that's where we left off on Friday. Okay, next we're going to get into some interfund transactions. This is going to be interfund services provided and used. These, remember, are going to be recognized as revenues or expenditures of the funds involved in the same manner as transactions with outside organizations. So stuff that we're like seeing before with the exchange-like transactions for the for-profit sector of accounting. So the first example here is just assume that the amount charged by the water utility to the general fund for hydrants and water services was $80,000. So the general fund entry is going to look like this. So obviously, if we've received the water services from the water fund, then obviously we've incurred an expenditure. So we're going to debit expenditures control for $80,000. And then we're going to credit due to other funds, water utility fund, right, for $80,000. So the general fund has incurred an expenditure for the water service, and we've set up a liability to pay the water utility fund for $80,000. Pretty simple, right? This thing is just awful. So, okay, another common transaction for the general fund is going to be for the receipt of supplies or services from an internal service fund. So let's look here and just assume that the general fund received $377,000 in supplies from the supplies fund, and later made a partial payment of $322,000 in cash. So the first entry 20A here, when we actually ordered the supplies from the fund, we actually received them. We're going to debit expenditures control for $377 for the full amount in which we received, and then we're going to set up the due to other funds supplies fund for $377 in the same amount, right? Because the general fund has received the supplies from the supplies fund, and now we're going to set up the due to that we're going to pay them for the amount received. And it also says that they remitted $322,000 in cash. So the entry for that is going to be a debit for the due to the other funds, the supplies fund, and a credit of cash for $322,000. So with this payment, why did we debit due to other funds supplies fund here?
You're paying off what was due.
Right. So we're reducing that 377 by 322,000, right? And obviously, then cash is being credited because we're sending it to the supplies fund from the general fund. Okay, interfund transfers is the next type of entries we're going to be getting into. And it says that assume the general fund made the budget transfer to a debt service fund for the payment of interest and principal. So the general's fund entry is going to be a debit to other financing uses, transfers out control of $204,000, and due to other funds, debt service fund of $204,000. So the main thing here is obviously it's interfund transfer. So we want to make sure that we label it as other financing uses, transfers out, right? And due to other funds, obviously, because we owe the other fund, right? So it's just really important for what you label on these journal entries, because ultimately that's where they're going to appear on those statements, right? Because we know assets, deferred outflows, liabilities and deferred inflows, transfers, all those appear at different points on the statement, right? So it's important that we label them as such when we do the journal entries. So once again, note that transfers are identified as other financing uses rather than expenditures, right? Because we're actually just using those funds as a transfer and we're not actually incurring an expenditure. Other financing uses are reported in different sections of the activity statement than expenditures, obviously. So next, let's look at when the cash is actually transferred, what the entry is going to look like. So obviously we're going to reduce the due to other funds. We're going to debit that for the debt service fund because we're paying the cash. So we're going to debit the due to other funds, which we originally credited in the last entry, and we're going to credit cash in this case of $204,000. So it makes sense, right? Not bad. Okay. Other transfers are non-routine transactions often made to establish or discontinue a fund. Now let's assume that the general fund made a permanent transfer of $596,000 to establish an internal service fund. So the entry that the general fund is going to make is going to be a debit to other financing uses, transfers out control of $596,000, and then cash of $596 being credited, right? Because we're transferring this money out to establish another fund, right? So it's going to be a debit of other financing uses because we're transferring it. Not bad, right? These journal entries aren't too bad. Does it help going through some of these examples? Okay, next let's talk about some interfund reimbursements. Now let's assume that $20,000 of the expenditures in entry 13B, which we went over last class, once again, let's not really try to keep up with these numbers, but let's just assume that $20,000 of the expenditures related to supplies used for the road maintenance, and it should have been charged to the motor fuel tax fund, a special revenue fund. So to correct this, $20,000 cash is moved from the motor fuel tax fund to reimburse the general fund. And accordingly, the $20,000 is charged to the motor fuel tax fund, and the general fund expenditures are reduced by $20,000. So earlier on, remember, the general fund actually paid this money. So they incurred the expenditure and paid the cash, right? So they debited the expenditure outlay and then credited cash. So now what they want to do is get that money back because $20,000 of it should have been to a different fund, right? So when they receive that money back, what they're going to do is debit the cash and then credit the expenditures control. That's putting the money back where it belongs. The $20,000 coming in, the cash is the debit. Remember, assets are original debits, and the expenditures control is an original debit as well. But we want to reduce that expenditure, so we're going to credit it for $20,000, right? So now we're intact in the general fund. Okay, now here's where we're going to get into what you were concerned with on Friday when you asked about the interest and penalties being what we do with those, how we have to write those off if we actually write off some uncollectible taxes, right? So this is dealing obviously with the write-off of uncollectible delinquent taxes. So let's say if the treasurer of the Village of Riverside received approval to write off delinquent taxes totaling $30,000 and also related interest and penalties of $3,000, this is what the entry is going to look like. For entry 24 here, obviously this is reduced. This is going to write off the uncollectible taxes, right? So in order to do that, we need to debit estimated uncollectible taxes and credit taxes receivable of $30,000. And why is this entry made here to write off taxes? Why are we not messing with any expenditures or revenues with this entry? think about the time of the levy. What did we do at the time of the levy when we levy property taxes? What's the entry? Now, so we have a receivable, right? Receivables are assets, right? So that's going to be our debit, right? Taxes receivable, right? Because we levied a property tax. But then when we do that, we have to set up what? Because not all of those taxes, we know we're not going to collect all those. So what do we have to set up? The allowance, right? The allowance for uncollectible taxes. So we debit taxes receivable, credit the allowance for whatever the percentage of the taxes we deem uncollectible, and then the rest is credited as what? Right, because we're on the modified accrual. So we're still using accrual. So once we levy it, because we have the power backing us in the government, right? So we're counting that as revenue. So that's why it doesn't interfere with it. We're reducing the taxes. But the whole point of setting that allowance up is so we don't have to mess with revenue, right? So we're just, because we've already reduced revenue by the amount we think that's going to be uncollectible. So that's why we're making that entry. We're debiting the estimated uncollectible taxes because that was an original credit when we levied it, right? And then we're crediting taxes receivable because we originally debited it. So that's bringing down those taxes. So those taxes are off the book now. That asset's been reduced. Same thing with writing off the estimated uncollectible interest and penalties. Obviously, when we accrue for these interest and penalties, remember when do we start accruing? The date that the tax is past due, right? And we accrue it until the date the tax is paid, right? So obviously we accrued 3,000 of those interest and penalties related to those 30,000 taxes previously. So with that entry, we debited interest and penalties receivable, and then we credited the estimated uncollectible interest and penalties, and then the other we counted as revenue, what we expected to receive, right? Same as when we levied the property tax. So when we're writing these off, it's going to be the same thing as writing off the taxes. We're just going to debit our estimated our allowance, right? Our estimated uncollectible penalties and interest. We're debiting that, and then we're just going to credit interest and penalties receivable. So same exact function as when we levy the taxes and we write off the taxes. So when we have an interest or penalty receivable, we're going to debit that, credit the allowance, and credit what we deem the portion to be revenue, right? So when we write stuff off, we're only concerned with the actual receivable and the allowance, and we're just going to swap them, right? Does that make sense why we did that and why it doesn't affect revenue or anything? And once again, really good noticing that on Friday that we have to do something with the interest and penalties as well, because it directly correlates with the relative taxes in which they were derived from. One other thing, when we write stuff off, taxes or interest, obviously it comes off the books. It comes off the GL, is no longer within the statements, but we still hold on to the note itself within it, because we could collect that at a later time. So then if that happens, we have to put the collectible back on the books and then recognize it as revenue. Same as for the for-profit accounting for when you actually have other income, recovery of bad debt expense. So it's the same entry there as you would see in the for-profit. Okay, let's see here. So accrual of interest and penalties. So once again, now this is going to be the front end entry we just talked about. We wrote off the bad tax, uncollectible taxes, and the associated interest and penalties, right? So we accomplished that. So now if we want to accrue interest and penalties, so it says the amount of interest and penalties earned by the general fund of the Village of Riverside and not yet recognized is $56,410, right? And it's expected that only $39,490 of that can be collected. So this is what the entry is going to look like. Obviously, we're going to debit the interest and penalties receivable of the full $56,410, right? Then we're going to credit the estimated uncollectible interest and penalties of $16,920 and credit revenues control of $39,490. We credit the revenues control of $39,490 is because that's what we expect that we can actually collect out of those interest and penalties. So that's how we set up the estimated uncollectible interest and penalties. Same way as levying the taxes, right? Straightforward. We debit the asset that we think for the gross amount of the asset. We credit the uncollectible amount, credit revenue for an amount we expect to bring in, right? Simple. We're good on levying property taxes and then seeing how we accrue for interest and penalties. Okay, deferral of property tax revenue. So once again, this is just dealing with that measurable and available rule. What's the available rule?
Well, the measure available is that the 60 days.
Right. So if we can expect to collect it within 60 days after the year end, it's available, right? Well, in this case, it's saying it indicated that approximately 40,000 would probably be received more than 60 days beyond the end of the fiscal year. So the 60-day rule requires that the 40,000 be deferred and classified as deferred inflow of resources on the balance sheet, right? So therefore, we need to actually reverse it because remember, when we levy a tax, we've already counted as revenue, right? We've set our uncollectible up, and it's the tax receivable, the uncollectible, and then the revenues control, right? Well, 40,000 of what we already counted as revenue earlier in the year is it's not available, so we have to defer it. So in other words, what are we doing? We're just moving it from revenue to deferred, right? So how do we accomplish that again?
You debit one liability and you credit another liability.
No, because we debit revenue, right? Because revenue is a credit originally, right?
Sorry.
Just like a liability. No, you're good. You're on the right track. So we debit revenue, right? Because revenue is originally a credit on original. When we recognize revenue, it's a credit. When we reduce revenue, it's a debit. So we're going to debit revenues control of 40K, credit deferred inflows, property taxes. So now, because remember, deferred inflows is seen with liabilities, right, on the balance sheet. So we've moved it from revenues from the top down to deferred inflows of property taxes down near the bottom. Moved it from the asset side to the liability side. Makes sense, right? And we reversed revenues control because we recognized it in the beginning, right? And we needed to reduce revenue and then move it to the deferred revenue. That's why we did that. Okay, next, dealing with a special item. So we know that GASB standards require that extraordinary items and special items be reported separately after financing sources and uses, right? So this is going to be the last thing we see on the statement of revenues and expenditures, okay? Obviously, special item, if we sell a fixed asset, right, that counts as a special item, right? So obviously, within the fund, in the governmental fund level, this is the entry we would expect to see, right? We're bringing in cash for $300,000 because in this case we've sold a plot of real estate, a plot of land. So we've debited cash because that's our proceeds, and then we're going to credit special item proceeds from sale of land, $300,000, right? That's in the fund level. Where would we expect to actually see the removal of the fixed asset? What statements would we expect that to be taking place on? Remember, we're in a governmental fund, and they account for what?
Current.
So where would we expect to see like a fixed asset? Because remember, current means we don't account for any long-term debt or any long-term assets, capital assets, right? So where's that entry for removing that asset going to be?
Government-wide?
Government-wide statements, because they're the full-blown accrual, right? The economic resource measurement focus. But this is the entry we would see on the fund level, because we still have to account for those resources, right, within the fund level. Okay, next, this chart right here, let's see. Let's skip it again. Maybe I don't have it on here. Okay, let me get this light back on. Sorry, I hate these lights that they just shut off. I guess it'd be different if you had more people in class and people had some movement. Here we go. All right. So now let's talk about some closing entries, okay? Just to recall, what type of accounts have to be closed at the end of the fiscal period?
The budgetary accounts.
Right. Including what, which includes what, which is also included as a budgetary account
Uh,
when you purchase something.
Encumbrances.
Encumbrances, which that is a budgetary account. I just want to make sure we know that's a budgetary account, and what other kind of accounts?
The revenues and expenditures.
The activity accounts, right? Because those are for the period's activities, right? The permanent ones, like on balance sheet accounts, are not closed; they stay open because those are the catch accounts. Where the activity accounts are closed to, right? So for the closing process, we know budgetary accounts and activity accounts have to be closed, right? So let's look at this entry here. So 29A. Let's just kind of ignore the numbers here, even though they do relate to what we've been seeing throughout these examples. So we know we're closing budgetary accounts here. We know this because we know that appropriations, estimated revenues, and encumbrances are all budgetary accounts, right? So we're closing these. So we see that appropriations control is debited here, and estimated other financing uses control is debited here. Why are they debited here to close this?
Because they're usually credit.
They're an original credit on the budget, right? When we're actually setting the budget. So we're going to debit those there. Estimated revenues control of 6.25 is credited here because when we set the budget, it was originally debited. So pretty much it's just a complete opposite, right? We're just washing the original entry we just did. If it was the original debit, we're going to credit it. If it's an original credit, we're going to debit it. And the fund balance is just going to move to the other side, right? So then we've closed the budgetary accounts. Next, we've almost closed the budgetary accounts. So now we have to close the encumbrances outstanding at the end of the year, right? So obviously we can see here, if we're debiting budgetary fund balance reserved for encumbrances of $50,000 and crediting encumbrances control, the government had $50,000 worth of stuff encumbered at the year end, right? And we know we have to close that, so we have to unencumber it. So now we've closed all the budgetary accounts, right? We've unencumbered the funds, and we've reversed the original budget entry. So next, we want to close the activity accounts, right? Okay, so once again, we know revenue is an original credit, right? When we're recognizing revenue, like so, if we levy property taxes, we know we're debiting taxes receivable, crediting revenue, obviously with the relative uncollectibles. So that's why revenue is being debited here because it was an original credit, same as the budget accounts. If it's original debits, you credit it. Original credits, you debit it. So revenues control is going to be debited here. Special items, proceeds from the sale of land. Remember the $300,000 that we credited as the special item. Now we're debiting that. Other financing uses transfers out, $800,000. Expenditures control is going to be credited here because we know expenditures are usually a debit originally. And obviously it's going to be closed to fund balance, right? So all closing entries are closed to what? Fund balance, right. And fund balance is like what in the business sector? Think of where net income is closed to.
It's like the
what do you do with your earnings?
Retain.
You retain them. So it's fund balance is like retained earnings, right? Net income and your for profit is at the end of the period is closed to retained earnings, which is a component of stockholders' equity. For governmental purposes, the accounts are closed to fund balance, right? So we got this closing process down pretty well. Okay, and once again, this is just a quick we'll just look at this for a second. Remember that fund balance has 5 categories, the non-spendable and the spendable categories. We won't really get into a whole lot of what it is, but in this case, for the problem we've been working through the statements, this is what the fund balance categories is going to look like, and it gives you a little breakdown of what it is. Remember, the unassigned is the residual plug value of the general fund because it's the only fund that can have a positive unassigned fund balance. And then assigned, remember we had 50,000 of purchase orders outstanding at year end that we had to unencumber. So that's what that is. Communications equipment 100,000. So these all relate to what we were seeing before. I just wanted to bring this back up to remind that the fund balance is displayed within 5 categories. The one of non-spendable, and then the other 4 spendable categories with different constraints. And I think we're all pretty familiar with the different levels of fund balance. Okay, let's talk a little bit about the special revenue funds now. So special revenue funds, let's just remember they special revenue funds. What are they originally created for again?
Things that aren't in debt service or capital outlay.
Right. So if it's not a capital projects fund or a debt service fund, then it's going to go for a special revenue for a specific purpose, right? What's something that differentiates the special revenue fund? Remember, GASB gives special attention to special revenue funds, if you recall that from, I believe, chapter 3, I want to say. But they give special attention to special revenue funds. So one thing that differentiates those from like a capital projects fund is it has to be either restricted or committed. Remember, it can't be assigned. Remember, if it's assigned, then they need to put the money back in the general fund. So it has to be either restricted or committed. So that's one thing that sticks out from the special revenue fund. That's that special attention GASB gives. So just remember, the funds have to come from sources of either restricted or committed funds. So let's just go through some examples we would expect to see some entries that we would make in a special revenue fund. So let's see here. This first one is for motor fuel tax revenue. So they obviously have a special revenue fund created specifically for motor fuel tax revenues, right? So if we get the tax off that motor fuel revenue, it's going in that special revenue fund. So it says during 2020, the state notified the village that it would be granted $650,000 in motor fuel taxes. Records show $575,000 was received in cash, and the remainder is accrued as a receivable and revenue because it's going to be received within 60 days of the end of the fiscal year. So it's available, right? It's measurable and available, so it's revenue. Motor fuel taxes are derived tax revenue. Under modified accrual accounting, revenues are recognized in the same year that the underlying transactions, which in this case is the sales of fuel by gas stations, takes place. So note that the control accounts are not used since there's a limited number of revenues and expenditures. So just kind of ignore that last sentence. So it says that there's going to be $650,000 in motor fuel revenues taxes this year, right? And of that, there was $575,000 received in cash, and the remainder is going to be a receivable because it's measurable and available. So the entry that this fund is going to make, the special revenue fund, is going to be a debit of cash for $575,000, right? Because that's what they received. The receivable, the due from the state government, is $75,000 because it's available, right? And then we're going to credit motor fuel tax revenues of $650,000. Makes sense, right? Okay, let's think about let's say we made some expenditures for road repairs, okay? The expenditures for road repairs amounted to $605,000, of which $540,000 was paid during the year. And right here, encumbrance accounting was omitted just for simplicity. So just know that they could have encumbered it there when they did that. So at this point, we're at the point where we actually have received it. So we're at the point where we incur the expenditure. So current expenditure, public works for $605,000. We paid $540,000 during the year, right? And then we set the other up as a liability of accounts payable for $65,000. So we incurred the whole expenditure, right? Because we got all the service done to repair the roads for the full amount of $605,000. We paid cash of $540,000, and we owe the remaining of $65,000, right? So not bad. These journal entries are pretty much the same, just pretty much like instead of using expenses, use expenditure, stuff of that sort. So it's pretty similar to a lot of stuff you've seen before. Let's think about a reimbursement to the general fund. This is, remember when we ordered those supplies from the general fund, from an internal service fund, a supplies fund. Well, example, entry 23 in the general fund example related to supplies originally charged to expenditures by the general fund. that were road repairs and should be charged to the motor fuel tax fund. So if you remember, the general fund already debited the cash and then credited the expenditures, right, to reduce their expenditures and get the money back from this fund. Well, now this is the entry that the special revenue fund is going to make. Obviously, they had $20,000 that should have been their expenditure, right? So they're going to debit an expenditure, the current expenditure for public works of $20,000 and credit cash of $20,000. So therefore, they've incurred the expenditure and put the cash out to the general fund, right? The general fund reduced their expenditure by receiving cash and crediting the expenditure. So this is the answer that the special revenue fund was made when reimbursing the general fund, which makes sense. They're paying them cash and they're incurring the expenditure that they should have had. Pretty simple, right? Okay, reimbursement grant accounting. So if you remember, a lot of times with grants, they can either give you the money up front and you defer it and then recognize it as you do the current expenditures that are required to be reimbursed, or you can actually have to make that expenditure first and then be credited or reimbursed back from it, right? Remember, if you recall, we went through a couple examples, but we'll get into it a little more here. So it says, assume the state awarded the village a grant of $450,000 for major repairs for the 3 village intersections. The funds will be released by the state only as work is completed as a reimbursement. So this represents an eligibility requirement under GASB revenue recognition standards. Remember, there was 4 different requirements. Some was the eligibility requirement, time constraints, and stuff of that sort, characteristics, constraints, stuff of that. So this is what we're getting into. So this is the eligibility requirement for revenue recognition. They have to actually spend money for the current, whatever that specific purpose is, in order to get that money back. So accordingly, grant revenues and receivables would be recognized at the same time that expenditures are incurred. So it says during 2020, expenditures in the amount of $350,000 were incurred. Of these, $280,000 was paid, and the village billed the state $350,000 and received $300 cash before the end of the year. So remember, expenditures in 2020 amounted $350,000. So we incurred $350,000 in expenditures, right? And it says that out of those, $280,000 was paid. So obviously, for this special revenue fund, we're going to debit current expenditures, public works, of the full $350,000, right? Because we're incurring that expenditure. We paid the $280,000, so we're going to credit cash, and we obviously owe the rest, so we're going to set up the accounts payable liability of $70,000. Now, remember, this is a reimbursement type grant, so we have to spend the money to get the money back, right? To be able to count it as revenue. So notice here on entry 5, now we're saying immediately, as soon as we made that entry with the current expenditure, we made that expenditure, right? Even though we've only paid $280,000 in cash, we're going to go ahead and set up a due from state government for the full $350,000, and then we're going to credit state reimbursement grant revenue of $350,000. Why did we credit or debit a due from the state for the full $350,000 right there, and not just the $280,000?
Because it's based on the expense.
It's based on when we incur the expenditure. So that's why we set up the full due from the state government, and we count it as revenue because the grants are ultimately revenues, right? We would have never incurred this expenditure if they weren't going to reimburse us the money. So it's money coming in we never had, so it's going to be a revenue, but we just have to incur an expenditure in order to fulfill the requirement that GASB has set forth, or that the donor required. And it also said that the state also paid them $300,000 of the $350,000. So that's where the special revenue fund is debiting cash and then crediting the due from the state government, because they're receiving cash, the asset's going up, and the asset of the due from the state is going down by $300 to keep it intact. So not bad, right? So for reimbursement type grants, what does GASB say that the actual government that is receiving that grant has to do in order to count it as revenue?
They have to incur an expense.
The expenditure or the expense, right? And then once they incur the expense, they set up a due from the government and count it at that point as revenue, whether they received it or not, right? Because we're on the accrual still, even though it's modified accrual. So that's just important there. So reimbursement types, once you incur the expenditure, you set up a due from and count it as revenue immediately, right? Not bad, right? Okay, now let's talk about the closing entry for this special revenue fund. So at the year end, the motor fuel tax fund would prepare the following closing entry. If you remember, we had the motor fuel tax revenues of $650,000 is what they said it was going to be at the very beginning. That's an original credit, so we're going to debit that. If you also remember, with the state reimbursement grant revenue of $350 we counted from the previous slide once we incurred that expenditure on the reimbursement grant. So we're going to debit that because that was an original credit in that entry. Current expenditures for public works, $975. And obviously the plug is going to be the fund balance, right, on the closing entries, because everything is closed to fund balance, right? Obviously there wasn't a lot of items that are a lot of different transactions going on here, so that was a pretty straightforward closing entry right there. I want to close. Last thing I want to look at. Let me just see something right here. Okay, so next I want to get into recognition of inventories and governmental funds. So we know when we're actually buying inventories, right? So when we purchase supplies or inventories, there's two different ways that they say that we can account for, okay? We have the consumption method and the purchases method, okay? The consumption method is going to be the most popular method of the two, okay? Under the consumption method, supplies inventory is going to be debited when inventories are acquired, right? When supplies are consumed, the expenditure account is debited and then supplies are credited, right? With the result that the expenditure equals the amount of supplies used during a period. So let's assume that the Public Works Department began the year with $4,500 worth of supplies, right? They purchased $50,000 worth of supplies during the year, and they ended at the ending inventory of supplies of unused supplies was $2,000 at the end of the year, okay? So what does it say for the consumption method? It says, under the method, supplies inventory is debited when inventories are acquired, right? So we can see here, this is the consumption method. So obviously the first entry, when we debit supplies inventory of $50,000 and credit accounts payable of $50,000, we've done exactly what the consumption method says we do. When we order supplies, the supplies inventory is debited, so we debited it, credit the accounts payable, right? But then what does it say? It says as we use the supplies, right? As we use it, we incur an expenditure. So throughout the year, obviously we've obviously in this case we used $52,500 worth of supplies inventory. So we've incurred the public works expenditure of $52,500 and supplies inventory is credited of $52,500. Okay. Let me see if they've given us the sample here. Nope. I'll go back to the other one. Okay, so for the consumption method, this is going to be something that we're used to seeing within the for-profit accounting, right? So think about what is the formula for cost of goods sold in the for-profit industry? Do you recall what it is?
I have it written down, but not off the top of my head.
So it's exactly what I just said it was. If you remember at the example, it's beginning inventories. The formula is beginning inventories plus purchases minus ending inventory gives you cost of goods sold, right? Beginning inventories plus purchases minus ending inventory is cost of goods sold. Well, that's the same method we use for this right here, okay? In order to get the actual $52,500 there for the amount used. We know the beginning inventories that told us was $4,500, right? They told us we purchased $50,000 throughout the year. So that's going to give us $54,500, right? Well, it also told us that we had only $2,000 left over at the end of the year. So $54,500 minus the 2,000 gives us the 52,500, right? So we know that's the cost of goods sold or the amount of the expenditure. Makes sense? So that's where the consumption method. So when you think of the consumption method, think of the cost of goods sold for the for-profit industry. Okay, your beginning inventory plus purchases minus ending inventory gives you what the cost of goods sold. The cost of goods sold is going to be the amount of the expenditure, or the amount of supplies used. Okay, so pretty good on that part for the consumption method. So for the consumption method, it tells us what when we order something, we debit inventories, right? Set up the payable, and then as we consume the goods, obviously we debit expenditures, credit that. Obviously, this is going to find what it was for the full year because of the formula. But obviously, as the year progresses, as we're using the supplies, then it's going to give us what that number is as well as we go through those, obviously, because of what they add up to is going to give us the cost of goods sold. That's just a way of finding cost of goods that I told you. So we're good on the consumption method, right? So we buy the goods, we put it in inventory, and then as we use them, we expense them, or in this case, it's governmental expenditure, and we credit inventory, right? Same thing. So for the for-profit, what do? We debit inventory, credit accounts payable, and then what happens when we make a sale, or when we consume that inventory?
We have to credit that inventory.
Right, we debit cost of goods sold, credit inventory, right? So same thing, we're just debiting expenditures, crediting inventory. Does that make sense? Okay, next is the purchases method, and once again, this is not as popular as the consumption method. So under the purchases method, expenditures are debited when supplies are received. So in this case, we're just going to skip debiting supplies and we're going to debit expenditures, right? So we can see right here, instead of debiting supplies, we debited public works expenditures for 50,000, right? Because that's how much we ordered throughout the year, and then credit accounts payable. Okay, and then obviously here we know for this one, if we have a non-spendable fund balance, say here at the bottom of 2,500 and the supplies inventory of 2,500, then what that is saying is that the supplies inventory actually decreased by $2,500. And the way we find that is because we have 4,500 beginning supplies inventory, right? And we know that the ending inventory is 2,000. So we just take the difference between the two, which is 2,500. So that's how much it's went down. That's the purchases method there. Obviously, the consumption method is more popular. I think it's a little more simple than using the purchases method. And the difference between the two methods is the amount of expenditures reported. Expenditures under the consumption method equal the amount of supplies used, obviously. And whereas under the purchases method, expenditures equal the amount of supplies purchased, as we can see, because the last time, remember, we had 52.5 for expenditures on the consumption method, so we consumed 52,500. On this one here, obviously the expenditures at the top was only 50,000, and that's the amount that we actually purchased. So between the purchases method and the consumption method, pretty straightforward on those two. So which one debits the supplies inventory?
That would be the consumption.
Right, and then once we consume the inventories, we debit the expenditure, credit supplies, right? For the purchases, what is the original debit to?
Original debit is to expense.
To the expense or expenditure. The consumption method measures how much we what?
Consumption is how much we've used.
Supplies. Right, and the purchases method is how much we've actually purchased. Right. Let me just see what these last little. It's just post closes. I just want to see if there's anything I want to touch on. No, I think that's where I want to stop today, because I think that's a pretty sound covering of chapter 4. Once again, chapter 4 dealt with accounting for the general and special revenue funds. Does it make sense on on the type of entries that we've seen that entered into these? Does it make a little more sense on how the entries are made under the modified accrual as opposed to the full accrual? That'll be it for chapter 4. Is everything? Are you understanding everything all right? It makes sense pretty well. That's it for chapter 4. Let's just take a look here at the Moodle to see where we're at here. Man, already week 5. It's hard to believe. Okay, so obviously that wraps up chapter 4. Remember, chapter 4 Connect assignments are going to be due, I think the end of this week, I believe. That chapter 4, that's right, they're a lag, a week behind. I get confused with some of my other classes. So chapter 4 is complete. Do the quiz and the homework for chapter 4 in Connect. It's due this Sunday at 11:59 p.m. Wednesday, we'll get into chapter 5. Chapter 5 deals with accounting for other governmental fund types. So we'll get into the debt service, capital projects, and permanent fund. And then that'll cover all the governmental funds. So that wraps up chapter 4. We'll begin chapter 5, like I said, on Wednesday, and we'll probably finish it up, I would say probably next Monday. That next chapter is a lot like this one. We'll be going through a lot of like examples of journal entries because I think those are really important to see how they enter into it, because ultimately that's how you build the statements and understand the transactions. Is there any questions on anything we've covered through the first 4 chapters? Pretty good. So we know we have 11 governmental funds, right? We have 5 governmental, 2 proprietary, 4 fiduciary. The 5 governmentals operate on a modified accrual basis. The other proprietary fiduciaries are full-blown accrual. And we've started seeing some of the entries. We know what statements accompany all of them now. We should be pretty comfortable on that. We know the difference between the government-wide statements and the fund statements. And we've seen some transactions. So I think we're moving at a really good pace. Hopefully everyone's understanding everything well. Like I said, as always, if you have any questions or concern, please just email me, or if you have questions on any quiz or homework or anything of that sort, just let me know. And as you can see here, I just want to say one more thing and we'll get out of here. You can see moving through, our midterm exam is slated for the week of March 2nd through March 8th. We'll also be doing project details that week. I plan on having a couple of days around this week and this week before we take the exam to review and do a really formal review for the exam. So it should be straightforward whenever you get your test. So with that being said, that's all I have. Just remember to do your Connect assignments, and hopefully everything's making sense, and we will start chapter 5 on Wednesday.